All right, before we jump right into things today, I need to share a quick but absolutely crucial note. This explainer is for educational purposes only, and it is definitely not insurance advice. Look, everyone's coverage needs vary so much based on their individual situation. So please, always consult a licensed insurance professional before making any major coverage decisions.
Welcome to the Explainer. Today, we are taking on one of the most expensive, yet kind of invisible habits in personal finance, staying blindly loyal to your insurance company. We all know insurers spend literally billions on advertising to give you that warm, fuzzy feeling, right? They want you to feel like a good neighbor, so that you simply won't bother shopping around. But here's the harsh reality we're going to unpack today. Staying with the exact same company year after year is costing you dearly. Loyalty in insurance? It doesn't earn you better rates. It actually earns you worse ones. Insurers charge long-term customers more because they know most of us just won't go through the hassle of leaving.
To show you just how incredibly high the stakes are here, let's talk about a real guy. Let's call him Marcus. Now, Marcus had been with the same auto insurer for 6 years, never shopped around. He just auto-renewed every single year without a second thought, paying nearly $2,900 annually for full coverage on his 2021 Honda Accord. Clean driving record, too. Well, one Saturday, he finally sat down and spent just 30 minutes comparing quotes. 30 minutes. And boom, he had a quote from a competitor for the exact same coverage, same deductibles, same limits. He made the switch and instantly saved $1,207 a year. That's a massive payout for a quick little task he put off for 6 whole years.
Okay, let's dive right into this. Here is the exact roadmap we'll use to systematically demystify insurance across every major category. We're going to cover the loyalty penalty, the auto insurance crisis, home and renters traps, life and health optimization, and we'll wrap it all up with a very actionable 30-minute audit.
Starting us off with Section 1, the loyalty penalty, and exactly why these prices vary so wildly.
You really need to shift your mindset right here, right now. Insurance is a math business. It's an actuarial math business, not a loyalty business. A policy from Company A and a policy from Company B that cover your car for the exact same amount are literally the exact same commodity. What you are buying is simply a promise to pay if something goes wrong. And listen, that promise does not magically become more valuable just because you've been paying the same company for 6 years. Pricing is based entirely on risk modeling. And this spread, it brilliantly illustrates the illusion of a fair price. Look at this. For the exact same driver, exact same state, exact same car, the lowest quote is $36.77. The highest? Over $8,000. That is a staggering $4,327 spread. Why? Well, some insurers had worse loss years and need to rebuild their cash reserves, so they charge more. Others price way below cost just to aggressively acquire new customers. There is no universal fair price. There's only the price a specific company decides to charge you today. The only way to know if it's fair is to compare.
Moving along to Section 2, the auto insurance crisis and how to reverse that painful 30% premium hike.
This category right here is where the absolute most money is being left on the table by the most people. Right now, average full coverage has spiked over 30% just since 2023, hitting an average of $2,679 a year. It's wild. To fight these skyrocketing rates, insurers are heavily pushing telematics, or usage-based insurance. Basically, if you install their app or plug a device into your car and you demonstrate safe driving, smooth braking, reasonable speeds, low mileage, you can save 10 to 30% on your premiums. But there's a catch. You are trading your data privacy. The insurer is actively tracking your driving habits. If you're a super careful, low-mileage driver, this could be a fantastic trade-off. But you've really got to weigh that privacy cost for yourself.
Aside from letting them track your driving, let's rapid fire through the absolute best levers you can pull for auto savings. Number 1, shop yearly. Listen to this. A massive 92% of people who switch carriers save money. They save an average of $648 a year. Next up, raise your deductible to $1,000. Doing this can save you roughly 40% on comprehensive and collision coverage. Just make sure you actually have that $1,000 sitting in an emergency fund first, okay? Third, if your car is worth less than $4,000, seriously consider dropping collision entirely. Fourth, bundle your policies. That usually gets you a 10 to 25% discount. And finally, work on your credit score, because insurers heavily weigh this in almost every state.
All right, Section 3, home and renters traps. We've got to watch out for the bundle trap and the nightmare of underinsurance.
But before we even touch homeownership, let's talk about renting for a second. $15. That is it. The average renter's insurance policy costs just $15 to $20 a month. I mean, that is an absolute steal to protect literally everything you own from theft, fire, and water damage. Plus, it gives you liability coverage. Most landlords don't actually require it, so most renters just don't bother getting it, but it is flat out one of the best value insurance products available anywhere. If you rent, go get this today, for sure.
Now, a huge warning for existing homeowners, especially if you happen to live in states like Florida, California, Louisiana, or Texas. You guys know the pain. Home insurance premiums have shot up 30 to 50% in just the last 3 years as insurers absorb catastrophic weather losses. So shopping your home insurance is arguably even more critical right now than shopping your auto insurance. But beware of what we call the bundle trap. We just talked about bundling discounts, right? Well, you cannot just assume that a bundled auto and home policy at one company is automatically your cheapest option. It's like a giant puzzle. Sometimes finding two completely separate best-in-class policies at different companies actually costs less overall, even without that shiny bundle discount. Always compare the total cost. Furthermore, whatever you do, do not fall into the underinsurance trap. Construction costs to rebuild a house are up 30 to 40% since 2020. If your home is insured for what it was worth a few years ago, you might not have nearly enough coverage to rebuild it today. So check your replacement cost estimate.
Section 4. Life and Health Optimization. Are you paying for the completely wrong type of coverage? So this is an area where the most expensive mistakes don't necessarily come from failing to shop around. They actually come from choosing the entirely wrong product right out of the gate. You have term life on one hand versus permanent life, like whole or universal life on the other. Permanent life policies are very often aggressively recommended by agents. Why? Because the industry earns dramatically higher commissions on them. But here is the stark reality. Permanent life is 5 to 15 times more expensive than comparable term coverage. For most professionals in their 20s, 30s, and 40s, a simple 20 or 30-year term policy is incredibly cost-effective and perfectly covers those high-risk years when your dependents actually rely on your income. Switching from a whole life policy over to a term policy can easily save you $100 to $300 every single month.
And hey, let's not forget health insurance. Here is a quote that perfectly sums up a massive annual mistake so many of us make. Most people auto-enroll in the same health plan they had last year, and it often costs money. Honestly, this is the health equivalent of just auto-renewing your car insurance. Your life situation changes, your income changes, your specific health needs change, and entirely new plans enter the market every year. So mark this specific date down in your calendar, November 1st, 2026. That is when open enrollment for 2027 health coverage officially begins. Do not just let it auto-renew without reviewing the new networks, checking your subsidy eligibility, and actually doing the math on your total out-of-pocket costs.
All right, bringing us to Section 5, the 30-minute audit. This is your personal, actionable financial playbook. Because let's be real, information without execution won't save you a single dime. So here's exactly how you spend 30 minutes in one sitting before your very next renewal date. Ready? Minutes 1 through 5, just keep it simple. List out all your current policies, your coverage amounts, deductibles, and premiums. Minutes 6 through 15, go online and grab 3 identical auto quotes. Make sure you are comparing apples to apples. Minutes 16 to 20, pick up your phone, call your current insurer, and tell them you have competing quotes in front of you. Ask if they can match or beat it. Sometimes they will magically unlock a loyalty discount right then and there just to keep you. Minutes 21 to 25, verify your home is actually insured for its current replacement cost. And if you're renting, go get that $15 a month policy right now. Finally, minutes 26 to 30, review your life insurance and verify you have individual term coverage that is at least 10 times your annual income. Boom, done.
If there is only one thing you take away from this entire explainer today, let it be this. Insurance is not a loyalty business, it's a math business. Run that math once a year, and if the numbers say to switch, you switch. It really is that straightforward. So, I want to leave you with a quick question to think about. When did you last shop your insurance? Drop your answer in the comments below. Let's see how many of you are way overdue for that 30-minute audit. And hey, if you found this structured breakdown helpful at all, please hit that like button, share this with a friend who you know is overpaying, and be sure to subscribe to the channel for more focused financial explainers. Stay smart with your money, and I'll see you in the next one.